welcome. Good morning, everybody. Let me get this all out and set up. All right, take a little minute to get set up. I wasn't flexing the waves, but they there. Wasn't flexing. I wasn't flexing on anybody just now. Let me see something. It's been a lot going on. There's a lot to go over today. I'm gonna make some good clips from this. Let me see, General. Okay, I'm gonna master this whole setup thing soon enough. It's just getting started, so still got to work some kinks out of the setup, but I'm gonna get it together. All right. Discord. Let's bring the trading view up. Let's bring the screens up. Let's see where we're at today. 405, huh? All right, so we've broken up. We've hit another gap up. 3 days in a row of a gap up. So if you're looking what I'm talking about, we see in the chart here, gap. That means we closed at a lower price and then we gapped up and opened up at a higher price. Not just any higher price, but it's usually moved by like $1 or more in price. So 396, we closed at 396, but then we open at 397, 39 or 398. That's considered a gap up. So we had one, two, and now three of those, which to me is a pretty bullish sign. It shows that a lot of institutions are coming in and buying overnight based off of news and sentiment of the market, and that's leading us into the day where it can come off as seemingly overbought because of the gap up overnight. We're like, so that's what's leading to, I believe, these pullbacks we see during the day, like this pullback we saw yesterday, where we gapped up to right here at this 404 level. Then we pushed our way back down to 401. And then we came back up towards the end of the day, and then today we gapped up to 405. So yes, we opened today higher than yesterday, but yesterday was still a kind of a bearish day because the whole day was in decline. And this is due to gap to the downside. So you see this little gap right here A lot of the times, if you have a gap up, what will happen the next day is that you'll have a refill of the gap back down. So all the people that own shares right here, when they see the market open up high right here, they trying to sell and take their profits. So they'll take profits back down, usually to the level of the previous close, and then the market will start to re-rally again. Yesterday, it didn't fill all the way back down, came about halfway, then it started to rise again, which shows that there's strength in the market right now. I want to look at volume, but let me get my Twitter started up real quick and get this Twitter space going. Algorithm for Twitter comes out at noon today. Can I get the link? Paid verifications has been the big debate. I don't mind it paid for verifications because it lets you know what's a bot and what's not. If people are willing to pay for a bunch of blue checks for their bots, that's some real deep investment into into botting and spamming. But I doubt people are going to want to do that. So this is my weekly chart. You see a lot of different levels when I pull out the weekly chart. Getting the Twitter space started right now. That's right, Tesla. Can't forget Bitcoin. All right. Spy's about to face some resistance here. Let me send out the message. Hold on, I'm coming. My guy Tim, what's going on, bro? Alright, I'm pulling out the weekly chart. I'm going deep diving today. I don't know how heavy I want to trade today, especially it being a Friday. I don't like Fridays like that. So I'm gonna watch. Let's see how the weekly is forming up. I want to see the volume on this weekly real quick. Good morning, y'all. How we feeling? How you feeling today? I'm doing well. I'm doing well. I'm still getting, my rhythm together and setting up the stream, the Twitter, and all that. Cause I'm live on YouTube right now too. Yeah, I'm about to tweet that out actually. This is why I need my guy Dirk in here, man. Dirk got to handle all this for me. Get those savvy young folks to handle that kind of stuff. Yeah, Tim was talking. We couldn't hear him. I don't know. Yeah, get the savvy young bloods to handle that. I'm gonna share this on Twitter as well. I could do it on my phone. Share Twitter. What's going on, bro? That's the I got money voice. That's the I'm making money voice. Well, you know when boy wake up making money. Yeah. Yeah. I'm gonna wake up with the green on. You got this. Nah, last night, yeah, that was you rolled the dice on that one. but but it was definitely. Yeah, I've seen what it's looking like. It's like now the dog's on the bark. Really, really, Cujo. But what I really see is like a lot of institutional buying happens overnight, pumps the market, and then they get out during the day, and then we have a sell off during the day to you fill the gap back down, and then before the end of the day it comes back up, and then it gaps up again the next day. It's been doing that same pattern for the last 3 days. And what's shitty about that is that with the gap up, you would think that's a bullish sign, or you would try to fill the gap, or you're going to try to take the gap fill back down. But if you took it as a bullish sign, then you got destroyed each one of those 3 days. What do you call it? That's the thing though, man. Sometimes you get out your trade while it's on that momentum rally up. You can't time the top, you know. So you want to get out before that reversal is even a thought to start happening. Sometimes. Now I gotta pin this. No, I didn't grab anything yet. Like I said, I don't know if I'm gonna trade today. Honestly, probably just do a lot of chart watching. Well, let me see. I'll tell you right now how that report came out. Do, 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 do. Hit up the website. Check out the calendar. I know today GDP came out. Yesterday, GDP came out pretty on par with what the estimate was 2.6%, and the expectation was 2.7. Uh, Let me see the. because I just want to see the history, honestly. So GDP came in worse than expected. I want to see the chart. All right, let me see some more information on this. So year over year, I'm trying to see last February. February, okay. 7% was last year, February. All right. Well, so GDP came in lower than expected. It probably caused a little pullback. The price expectation came in alignment. It means inflation is still going down. So jobless claims came in a little bit higher than expectations. So we could be starting to see the rise of that shortening in the labor market that they've been talking about, or the Fed's been trying to get to happen. They've been trying to get people to start or stop hiring and start firing to weaken the labor market that's been so strong. Today was dominated by OPEC news today. I see OPEC and I see Michigan consumer expectations was at 59.2 compared to the 61 expected. So consumer expectations came in lower, which shows that there's not that much confidence in consumers right now in the market compared to what they expected. And it's been dropping. The Chicago PMI manufacturing index came in at 43.8 instead of 40 inflation. Oh no, it's the economic health only. For what? Michigan came in at 59.2 instead of 61.5, what they expected. So it came in lower. Consumer expectations and consumer sentiment came in lower as well. Instead of 63, it came in at 62. Today seems to be dominated by a lot of OPEC news and OPEC talk, which should be interesting, especially with all the new collaboration between China and Saudi Arabia. I don't know if you guys been seeing that. I've been posting that up in the Discord, those articles, because that stuff is crucial. China and Saudi Arabia are starting to put together this, I guess, $15 billion oil project out there they're trying to work on together. And I believe Saudi Arabia is going to start to do trade in oil with China, and they're going to be willing to accept the yuan in exchange for oil. They're not going to require people use the U.S. dollar to buy oil from them anymore. They're going to allow people to buy oil from them directly with the yuan. So before it was like you had to convert your currency to U.S. dollar in order to get oil from them. Now the yuan is able to do the same thing, which is going to empower the yuan even more. So China is buffering its powers by pretty much creating a coalition between them, Russia, Iran, and Saudi Arabia, and Brazil. Brazil is actually part of that union as well, which is major. Probably the second most, and you already know they're heavily tied in with Africa. So Kenya just announced that they're starting to stop use of the U.S. dollar in Kenya. They're about to stop using the U.S. dollar, and I'm pretty sure that's going to lead to them either starting to use more of their own currency, which they're trying to do, but the partner currency for global trade, if they're not going to use the U.S. dollar, is probably going to be the yuan. That's what they're going to turn to for their global trade. That could be bad for us on an inflation scale. That could cause the U.S. dollar to inflate drastically. Oh yeah, so they're pretty much establishing this coalition of trade with each other, saying that we're going to trade with each other our resources using our currencies. We're not going to use the U.S. dollar as a standard anymore. They don't want to use the U.S. dollar as the global standard anymore. They're pretty much trying to de-rank it as the world reserve currency, and that's going to strip a lot of power from us as the United States, because that's a big foundation of our power. That and our military are probably the foundations of our power, because we don't produce a lot of resources. So we can't turn around and say, you know, we just could produce more of these resources to bring more value. We don't really produce anything. We're consumers of everything. So we're gonna see how this pans out. But I think it's time to start racking up on your Bitcoin. XRP took a big jump yesterday. XRP took a big jump yesterday. VIX is still breaking down. I said XRP took off yesterday. XRP is at 57 cents now from 30 cents. It's finally taking this move because I think that court case is about to be settled. If they consider XRP and it could be filed as a security, that's it. It's going to take off. Which I believe they will classify XRP as a security, which is going to then force them to classify a lot of other coins as securities as well, because XRP, the type of coin it is, aligns with how a lot of altcoins are created. So if they classify XRP as an altcoin as a security, that means a lot of these other coins are then going to have to be classified as official securities as well. They can't just be I guess what are they classifying them now as, like speculative trades, and they're not really listed as securities. But this will give them more validity, but it will also give them allow them to be subject to more regulation. But people are seeing regulation as good for the crypto industry, so they want that to happen. Essentially, they want it to end up being regulated so it can be globally adopted and used. But yeah, they're not going to trust it. So it needs some regulation. So that's why this is such a big case. Like if they win that case, bro, I think XRP is already lined up to ready to be used and wanting to be used by a lot of big organizations for certain things, and they just can't announce publicly that they're willing to use them or wanting or using them already. But once this case goes through, watch how much stuff comes out that XRP is integrated into already on the government level. And even on the government level, our government uses the XRP technology for some of the things that it's forming, like the FedNow system. A lot of that stuff is using XRP to help support that kind of system. So I'm just interested to see how that pans out. But the pullback, it's pulling back, right? Well, it's at 405. Oh yeah, it's just sitting there. I have a level. Let's see. Yeah, we stuck at 405.48. I gotta look at volume. Let me look at volume on this breakout compared to the volume that we had on the pullback. So we had, yeah, I would say I started looking on the macro scale and look at macro volume over like weeklies and dailies to see the change in volume throughout the days to see if we're in a pump out, because you can see like, oh, this is a real low volume move, or this is a real high volume week. And it'll show you the validity behind the move. Like if this push up has a lot of volume behind it, then it's gonna be harder to reverse it. If this was a week where we had lower volume compared to the previous weeks, then it could be easy to reverse. So that's why I gotta figure out. I gotta start looking at more the average weekly values for like SPY. What's the average weekly value? So if we go below that, it lets me know it's a low volume week. If we're above that, then I know it's a high volume week, and that move is probably more valid. Yeah, yeah. So we could just look over, just glancing, just a quick glance at going over the weeks up until August 2022. It looks like our average volume is around 300 to 400 million on a weekly basis. Like underneath 300 million, probably low volume week. Above 500 million would be considered probably high value, just from my glance and what I'm seeing. Like that big down move we made in May 2022. Let me see this one right here. 400, 645. Yeah, those big moves. So usually when we get a big candlestick of a move in a direction, what I'm seeing is that the following week we usually have like a recovery. If we have a super heavy value. Mm-hmm. Yeah. Okay, good. Oh, okay. Yeah. Yeah, this after this weekend, this Monday coming up, I'm gonna announce it this weekend, the pay your bill challenge. So I want people to pick a bill that they want to have paid, and we're gonna take a fraction of what you would need to pay that bill, and build it up so you're able to pay that bill. So some people may pick rent, some people may pick their phone bill, some people may have other bill they want to pay. But I would say whatever bill you want to pay, take like I was gonna say take 10% of that and let's put it in the market, and let's see by the end of the month. By the end of the month, if you take 10% of your portfolio, right, 10% of what it takes to pay your rent or pay your bills. What I see is that you gotta. Let's see something. Nah, I'm making up the percentage. Because really, what I want to do is I wanted to make it in a way where in three effective or four effective 30% trades compounded, you'd be able to pay your bill. So I gotta redo the math on that and make sure that it makes sense. So really, it's probably gonna be more so like half or whatever the bill costs. So if you got a phone bill that's $100, we're gonna take $50 and we're gonna flip that into your $100 by the end of the month to pay your bill. So essentially, you will have to double your investment. In order to double your investment, you got to get 100% gain. So to get 100% gain, the way I break it down is going to be 330% gains, or 330 plus percent gains gives you like right around 100% return. So that's how I'm going to execute it. Pretty much is do three. find 30% trades that we can execute throughout the month. So we're not trading every day. It's not going to be a necessity to trade every day. But when a good opportunity arises, that's going to be when I have a call to action for people to make their trades, so we could get that 30%. And if it rallies more, great. But we definitely want to lock in 30%. So do that 3 times a month. You get a W. You pretty much doubling your money as long as you keep the money all in the trade. Hmm. Yep. Yep. So let me see. Just looking at the weekly and scanning through what I'm finding. Okay, what makes me feel more likely that we're about to head into a bull market for sure now? Let me just do a confirmation. Let me look further back. I want to see something. Let's see the last breakout. So going back to 2021, all the way from September 2021 up until now, it's either a sign of how different our market and our times are, or it's a sign of some type of rally getting ready to take place. So on the week of March 13th, there was more upside volume. That's when we bounced off that base. When we bounced off of 380. There was more upside volume compared to up down volume. It was 19 million in favor of buys on that week. And there hasn't been a week where there's been 19 million more buys than sells in over 2 years. 19 million. Like there's been some that had 8 million, 9 million, 10 million. This shit came with 19 million. That's a very big difference between buy and sells in that one week. So that means we have heavy support coming from that candlestick on March 13th. So it'll be very hard to reverse that unless we get extreme down volume. It'll take a war. Like for real, it'll take war for that kind of push down to happen. I think we're coming up on our levels again. If you look on the weekly, we're coming up on that 408 level and that 410 range. That's a super strong level. 413.05 is another very strong level. So we will have to break 406.60 first, then 408, then 413. Those are all pretty strong levels, but none stronger than that 413.05 level. That causes heavy rejection. But we are making higher lows on the weekly. So if you look at it from the low we made in October, since then we've been making higher lows. So the next pullback, we couldn't have another pullback. We may push up this time. If we push up this time, if we could push up above 415, and that'll confirm that we're in a bull trend. Because then we can have a pullback. We could pull back all the way to 390 and still make a higher low. 'Cause Yeah, they call that usually is called like market consolidation or the base. The market is found the base where it's not going to break no lower than what we've seen in this time frame. So what it's doing is letting us know that it found support there, and then it could be getting ready to springboard again and take off crazy. So those are usually the best times to be dollar cost averaging into your investments, loading up on stuff because we're at a base right now. You can see that we're not in a bear rally, we're not in a bull rally, we're just basing out. So I'm like, okay, this is the time frame you want to get in because it's not going to pull much lower than 360, and it's not gonna. It hasn't been pushing much higher than four even at the highest 420. So you're buying in that range, and you're saying like, okay, I'm holding for the long term on this, but I gotta find the best spot in this range to buy in on, and then get in there and just ride it out, and don't allow myself to lose more than 10% on the investment, and on an option trade, like 20% on each option trade. Keep the stop loss like lower than that. But my long term investments, if you got a long term investment, none of the long term investments should be more than 10%. That means you picked a bad entry. That's all that means. You got in at a bad time. You had to re-exit and re-enter at a better time. Mm. Yeah, your entry gotta be on point. It shows you that how patient you gotta be sometimes, and just looking, watching for the right move. Like I give Ian credit for that. The master investor, he talks about that a lot. He says like he gives out these pullback prices sometimes, and people be like, "That's crazy," because of how much cheaper it is than where the price is currently. But it's like that's almost a discipline you gotta have to really catch these stocks at very secure prices where you know like if it drops down 10% from here, then it's either about to tank or I made a bad decision because I waited for a good amount of time for this type of pullback and I had this marked off. So some companies he'd be like the spy, like people will hear the spy at and then 400 and be like, oh, you should buy in when it gets back down to 330s. People are like, what? Like 330s? It's never going to. And then it touches there, and then people are like, oh shit, this was the time. But you were already taking losses because you bought in at 380 or 400 when you thought it was low. So I'm starting to see that more. Like, just have more patience. Sometimes you gotta sit in cash. Doesn't mean you stop putting money in your investment account. You keep putting the money in your investment account, but sometimes you got to sit in cash for a little while until the opportunity presents itself. Go ahead. Let me see. Let's look at Apple on the chart. I love looking at SPY because it encompasses the whole market. But let's look at some other. So SPY for me has a heavy support at this level with this 390 at 390 349 level I got. And it looks like volume to the upside has started to slow down some, especially off this major rip up we had. But that was a lot of battling in that candle. For that much upside volume, for enough to push more than that, lets me know there's a lot of battling going on in that candlestick. This week's about to close out. It's going to close out with very low upside volume comparative to the last 2 weeks. So it shows momentum slowing down to the upside. Let's look at the previous weeks and see if we see the same trend. So from the bottom, we had 6 million positive day, followed by 8 million positive week. I'm sorry, positive week, followed by negative 11 million. So that canceled that out. followed by, okay, so this right here, we had a push up, but there was negative volume for the week. Overall volume was negative for the week, but we had a push up. Okay. Then you went back to 3 million, 5 million, 13 million was the peak. This candlestick right here would have gave me cause for concern that the rally was about to fade out. And it hit a 399 high here. How much prior did the rally go? It went up to from 399 to 410. So you could have saved yourself by identifying that trend reversal here through volume, selling, getting out, collecting your gains from this run up that you probably profited from. But this is the spots that people are so concerned about missing out. Oh, I sold here, but it rallied up all the way to 410. I could have sold right here. How skilled do you have to be to time that and catch that? You got to look for the signs in other places. So the volume gave the first sign. On the way up, we had 6 million. Okay, that's decent. 8 million. Okay, that justifies that push up. 11 million pullback. All right, that's pretty heavy pullback right there. But then we had an up candlestick with negative volume, which is divergence. Shows a pullback is coming. How soon after, you don't know. It took 3 weeks. It took 1, 2, 3. You would have to wait 3 weeks. It would have been a wait from November 7th to the 28th, where it started to show heavy volume. So you probably think, oh, I should jump in right here because we're peaking up in volume. Nope. The pullback started right there. Negative 4 million, followed by negative 8 million. 2 million positive, negative 2 million. So these weeks canceled each other out. Flat base. Negative 1 million on rising volume, on rising candlestick, then 3 million. Negative volume, okay, break candlestick, makes sense. 8 million positive, okay, it justifies that push up that week. And this is just looking at the weekly chart. Of course, there's a lot of other factors that you're encompassing in with looking at this chart. But this is showing you how you will use this chart as guidance on momentum and where the market's going. Now you got to pull into the factor of what's happening as far as interest rates, inflation. These reports come out. So certain weeks, certain reports drop. So this could be a week where inflation report came out. That's why we had so much volume to the upside. What are they barking at? Oh, Lord, these dogs are barking crazy right now. Right when I want to be talking, they want to start barking. Shut up. Anyways, so you don't put everything on one indicator or one type of chart. They all play into each other to help you come up with a consensus idea. I say find your favorite three to work with, like mine's are price levels, macro charts, and volumes. So if I see something approaching a price level, I have certain resistance marks. So on this rally right here that we were talking about earlier, where we had negative volume but up push, it hit my level, my crucial level of 399.74. So on that rally up from down here, the 399.74 stop out would have been a good signal for me as well. The fact that we started resisting at that price heavy would have been my first signal. And then I would have started looking at the volume and divergence. Okay, let me get out right here because this is showing as heavy resistance. Then I would have gotten out. I would have saw the pullback. Then I would have saw the push up. Like, oh man, should I have gotten out? Then I would have to look at my next levels up. Like, is it really going to rally? Are we really going to break out from 400? So from 400 to 410, that's like a 2.5% rise. That doesn't signal a breakout for me in SPY. So that could be considered a pump fake, which it was. And then it pulled right back down. It came all the way back down to 382. Now, with this being another one of my price levels of heavy support or resistance, I could say, all right, on this pullback, do I think it's going to keep pulling back to these lower levels price levels that I got, or do I think it's going to find support here? And do I feel comfortable buying in at these levels? On these weeks, it actually dropped down to this level right here, to 374. As you see in the wick, it just didn't close there. So it gave the opportunity to catch it at this low price near this lower price level. And if I didn't catch it there on the way back up, I can say, oh, I'm gonna catch it here at 379. Either one of these levels I catch it at on the way back up, I could still sell out right here. I find this as my point. This is a good range that we've been in. If you want to buy and sell in this range, that 381 to 400 was a good buy and sell range. But like I said, it's a combination of all your indicators and resources to help you come up with a conclusion on which way the market is going. And even with all that, about 40% of the time, so with this information, you could bring your accuracy up to from 60% to like 70% predictability. Now that's pretty good, but that means at least 30% of the time you're going to be wrong, and you'll still get some bad trades and false signs, false signals that you react off of. Which is why I like the macro charts more because they're a little bit stronger in their signaling, and you can see that you will take some losses. But the key is when you're taking these losses is to make sure that you're limiting your losses to no more than on an option trade. This is my theory, not financial advice, but my theory is on option trades. You don't want to allow yourself to take more than a 20% loss, 15 to 20%, especially if you're taking weekly option contracts because they're so volatile that if you put the stop somewhere close to like 7%, 7 to 10%, you'll probably be stopped out very quickly on a lot of your trades. So that's why I say 15 to 20%. Because if if an option goes down 15, 20%, you probably picked the wrong time to get in. And it's just best to get out before you start taking 40, 50% losses, which can happen very quick with options. But with stocks and investments, you want to stop yourself out at like 10%. You don't want to allow yourself to take more than 10% of a hit on a stock investment that you're making. Not a options trade, but actual security that you're buying, whether it be gold, Bitcoin. Well, Bitcoin may be a little bit different because crypto volatility is much different than the market. But when you're dealing with blue chip companies like Apple, Microsoft, the S&P 500, you don't want to allow yourself to take more than a 10% hit on that stock. So if you're taking a 10% hit, it probably means that you picked a bad entry for that stock. For example, right now, a 10% hit on Apple would mean Apple would have to go down $16.20 from where it's at now. So if Apple dropped $16 from where it's at now, you're looking at that means you got in. That means you got in a little late, and that means it pulls back all the way to. Look at all the levels I had before we even get there. It pulls back down to this 149 level, 148 range. So you want to look and you want to say, okay, if you bought in here, if you're buying Apple right here, and Apple pulls back all the way down to 149, yeah, you picked a bad time to get in. Doesn't make Apple a bad company, just makes your entry a bad entry time. So you could look back and say, how many times could that have happened on a company like Apple, considering how strong of a blue chip company it is? Let's look on a daily. Let's look on the daily chart. Gives you a little deeper perspective on that. So, in order to sit out a 10% loss on Apple, means you would have had to buy Apple. Remember, we said that's about $16 down from where it's at now. So at any point, if you bought Apple at any of these points, you would have got stopped out this one time right here on January 23rd. You would have got stopped out if you bought Apple near its high of 162. So that shows you that you only got stopped out once in this process if you bought at the absolute wrong time. If you bought Apple at any of these price levels lower, which you should have based on, like I said, contextual trading and knowing your price levels and knowing what levels you want to get in at, you should know that these are some of the higher ranges just based off of historical data. So historical data will show you that on a push-up, Apple had a crazy push-up right here. Apple, these are all-time highs for the first time Apple had hit this point in its history. So do I want to buy this all-time high? Potentially, because it can allow for a push-up further and it shows strong momentum. But even if you bought it at its all-time high here of 124 and it pulls back to 104, you would have to get out that trade. That's a 20% loss on that dip right there. But at the same time, you got to look at context and what was happening. This was coronavirus caused that pullback in Apple. So that's why I said it's important to have a full round picture of what's going on. So in this pullback right here, if you understand this is coronavirus that's causing the pullback and panic, it's not anything to do with the company itself, then you could see this as a buying opportunity. You know, especially if you're someone who got an Apple down here, because if you got an Apple back here, which is considered a good entry, mind you, this was an all-time high for it at that point because it never reached this price level before, but this would have been a good entry because it rallied heavy from that all-time high. And you wouldn't have to worry about this pullback right here because it doesn't put your account negative by 10%. You're already up in this rally. If you got in right here at $72 and it went up to 120, you're almost up by like you're almost up. You're probably up around like 80% on your trade. So if a pullback of this magnitude is not going to stop you out of your trade. But if you got in up here and a pullback right here, that would have stopped you out. That would have showed you this was a bad time to get in on that pull because you got caught up in that pullback. So you sell. Let's say you sold it at the 20% cutoff point for option or 10% cutoff point for a stock. A 10% cutoff point for the stock would have had you selling. Let's see if it was at 129 at a peak. So it would say at like $13 down from there. So at 116 you would have had to sell, right? Now you'll say, damn, I got stopped out. I had to sell. But you would have saw it continued to drop from there. 116 and went all the way down to, what was the low that week? Going down to 106. Then the following week it went down to 103. So you saved yourself that further loss that you would have taken on the pullback by getting out with your stop loss. Being an individual investor, you can jump back into your trade. So what happens is, being that it's Corona, and you know that's a external event that's causing this pullback in the market, you start to see when you listen to the news and you start hearing things about recovery, you would start hearing about the Fed stimuluses, and you see that reverse in this volume on this week right here. Previous week, you had uh, positive volume with negative flow, which is divergence, which shows that we could be coming on the breakout soon. But then we had negative volume, negative 4 million, negative 9 million. That was a heavy sell off. Positive 4 million volume on this week, followed by a negative 5 million, positive 1 million. Then we had a gap up. You see, that was a big gap up that happened. So I'm using the volume, but the volume is not helping me too much here because it's like, okay, the volume isn't signaling strong bullish momentum yet. Okay. So what I was then look at, I had these my price levels and momentum on the chart. So I will say, okay, this was an engulfing candlestick. This is a technical thing. From one candlestick, you have a negative candlestick or a positive candlestick, and then the following candlestick is in the opposite direction, and it can almost engulf the entire previous candlestick. So that's an engulfing candlestick. And with the engulfing candlesticks, usually that's a signal into that direction, either bearish or bullish. So you're going to be looking at 116 as you want to try to get back in before it gets back up to 116. If you see momentum picking back up to the upside, especially if it dipped all the way down to 104. So you're looking for that re-entry because you like Apple. You know Apple's a strong company, and this only happened because of the coronavirus. Some other companies, you wouldn't take the same approach because they may not be solid companies like Apple or big blue chip companies that have high volume trading behind them. So those smaller companies, you have to take a different strategy and approach. But with Apple, you go ahead and you would say, okay, I see volume starting to reverse on this week of September in 2020. And we topped out, our high of the week was at 112. All right, that's pretty decent. So you know what? I look like I want to get back in. And on top of that, I saw that it came down to one of my support levels and it got caught. It didn't break through. So on this pullback here, I will be looking for my support at 103.67 that have been broken and continue to trend back down If we were going to continue the downtrend, that's what I would be looking for. But if I was looking for a reversal to the upside, I would say, does my support level catch it and does it bounce off that level, which it did. And then you could re-enter at that point and say, okay, well, my support is showing that it's strong and that it's going to hold and that it's holding right now. So let me get back in at this level, try to get back in around 103 and try to time it as close to your level as possible because you made this level for a reason. This level has a support factor to it, a resistance factor to it. So you made that level for a reason. Trust your price levels, trust your technical skills, and say, okay, this is the level I want to get back in on. And you got back in as close to that level as possible. You may not catch it right on the nose, but if you did, that would have been lovely because you would have caught it right there at that 103.90 level. And then from 103.90, it would rally back up to 116, 114 the next week. It pushed up, and we went all the way to the following week to 117. So now the 10% pullback rule changes for you from at this point. So now a 10% pullback from this point would be like $11, right? $11.70. So if it was a pullback from 117, if we were to end up having to pull back down to 107, 106, you would have to get stopped out again, right? So now you look at this right here. You look at the chart over here. You see, oh shit, we're rallying up. You end up having a push up, pull back right here. At the 10% range, you would almost got stopped out right here, but then you'll see a double bottom. You'll see it double bottoms out right here and it rallies back up. So if you cut it at 103 and you set your rule to be, I'm sorry, you caught it at 103. So 10% loss for you would honestly be down from 103. That's my mistake. So that would be like a $10 loss. So you would have to have the stock go down to $90 for you to be stopped out now at this new level you caught Apple at. So you got Apple here at this level. So now even on this pullback, that if you caught it at the top here of 120 and you were following the 10% pullback rule and the pullback to 107, you would have got stopped out again. You know? So you gotta say to yourself, it's all about timing and entries. If you're catching things near its peaks and you're getting caught up in pullbacks, it's gonna force you out if you're following your rules. But the rules are there for a reason. Stick to the rules because they save you a lot of damn money. It may seem like sometimes you get stopped out of position quickly because it drops down 10% quick. That's okay. It just means you picked a bad entry, it's a bad trade, and you probably got to look at some more factors with the company. If you still feel like it's a strong company, check your price levels again. Look for a good re-entry price on a pullback and get in on that price. So that's my nugget. That's my nugget for today on macro charting and looking for levels and using context to help you trade. Let me see something. So we apply that same method in theory to here, right? Apple hit an all-time high. Let's see Apple's high. Let's pull the chart out. Apple 52-week high of 178. Right now we're at 162. Right. So you'll see it rallying up, pushing up, pushing up. And you say, okay, I want to get in on Apple. Right now, if I want to get on Apple, I add to my long-term position because I'm already in on Apple. If I want to add to my long-term position, I would say I'm gonna watch my price levels. I'm gonna say right now for Apple, it looks like this 154.72 level I got for it is showing as a strong support right now. So before I add into Apple, I will wait to see if it can hold this support level, right? Or if I add into Apple right now, I would say if it breaks down below the support level, that'll probably be my early exit instead of waiting the 10% because I know if it breaks down below the support, we're most likely in for a larger pullback. But if I'm staying in and I want to add, like I said, to my long term, my level back. Come on, right there. And I say, okay, Apple seems to be in a good bullish momentum on a weekly, catching a bullish signal. You know what? Now is the time I want to get in. All right. I'll get in on Apple now, and then I'll say, when Apple rallies up, if it gets around that 176 level right here, I'll start to take some profit, you know, because I know this level could face resistance. And if it breaks above that level, I'm looking for these next two levels up, 179, 182, to start taking some profit. Now that's on more of a swing trading mindset. If you're more of a long-term investing, pay and hold, buy and hold kind of concept for 3 to 5 years, which, like I said, for individual investors that aren't savvy with the market, yes, you could take those approaches, very simplified, straightforward. Buy in, dollar cost average in on lows, and let the market momentum take you up on these solidified blue chip stocks or indexes. But if you're a more active trader and investor, then you can look at the levels you have set and determine places where you want to take profit at, and maybe re-enter at different prices on a pullback, or you want to leave your money in and see if it breaks to new highs. So a company like Apple, I like them long term. I would say they double top around this area, like I said, 179.80. I would ride Apple up to 180 and see how it starts to react around that level. If we could hold this range right here, once it gets up to 180, if it could hold back above 170, because you're bound to have a natural pullback after that much of a rally. As long as you can survive that 10% pullback, it doesn't really matter for you, because you're already so much in profit that if it pulls back 10%, you're not taking a loss. Your crucial level is always 10% below where you bought in at. That's your stop out level for long-term investments. Take profit levels are different. You got to determine when you want to take profit. A lot of the times I say use your levels to determine profit taking points. So right here, I would say 178 is a good profit shedding point. You know, doesn't mean sell all your Apple right here, but if you want to take some profit off the table, this is a level that it will be probably good to do that around, because a lot of people seem to take profit around this level. Oh shit! Why did it do that? Right there. A lot of people seem to take profit around this level, and what happens is you'll have a little dip pullback where if you take profit at this level, you may get another buying opportunity like it did right here. Like, hit that top and a pullback. You may get another one of these opportunities to buy in one of these zones right here, your yellow or reds. That's why I mark it blue, yellow, or red, because in those different sections shows the temperature to me. So if it's up here, we're real hot in the market. Like, that's like, you don't really want to be buying too heavy right in these zones because the market is rallying high. Or, I'm sorry, you do want to be buying a little bit heavier in these ranges because it shows that we're picking up momentum and the market is picking up strength. Down here, it shows that we're weakening, we're losing steam. You don't want to buy too much. In this range is where it gets tricky because you're in that mid range. It's like, do I buy or do I wait it out for another pullback? I say use your price levels and buy based off of those. So if we hit a low and you have faith in the company, you got to use your price levels as support. But I say don't try to catch a falling knife. You probably want to start buying in more so when you start seeing strength. Like this push up right here would have been the time to buy in. Not on this pullback. People will say, oh, try to catch at the low. You would have thought this was the low at one point. And you would have been trying to buy in right here, and then it would have went lower. And then you probably, if you're using the real trading rules and trading by any kind of rules and standards, you would have got stopped out right here. The Wild Wild West traders don't trade by those, so they just stay in the trade, and a lot of those people end up getting burnt out. Some of those people make big gains on some plays, but a lot of those people get burnt out. We're here for longevity. So for longevity, you got to trade with certain standards and rules. But for Apple right now, like I said, Apple's in the uptrend. I would have bought in or added to my position probably on this candlestick right here on March 13th, because we've seen a consolidation on the weekly. Consolidation is when the chart starts trading sideways for multiple weeks, at least 4 to 5 weeks. So 1, 2, 3, 4, 5, 6, 7. 7. That's perfect consolidation. 7 weeks on Apple. It's trading in the same exact price range. Now it's starting to break out. So when you experience something like this, or you see something like this happening, this could signal you a time to buy in. So consolidation within consolidation on this, on the SPY, anything, any large charts. When you look at large time frames, if you identify consolidations, those are usually the time and zones to buy in on good stocks because they're going to experience a breakout after. How far of a breakout? I don't know, but this should serve as your next support zone. So now, if you buy an Apple at, let's just say 150 to keep it neat, at 150, if you buy Apple at 150, you should not hold Apple if it drops back below or back down to 135. That's a 10% loss. So at 135, you should definitely be selling Apple. But a company like Apple, you got to ask yourself, how likely is it to go from 150 down to 135 if you're catching it into strength? Not very likely. So this should be a great entry at 150 for Apple, and you shouldn't be getting stopped out of that at any time soon. If anything, you start trying to determine better points to buy in at on the way up. So these price levels help you determine shed prices or buy-in prices. Right here, I will be looking at these as buy-in levels all the way up until maybe the 180s, like 179, 180 is when I'll start looking to probably start shedding or take profit on some of these stocks that I have, and then look to re-enter on a slight pullback later on, while keeping some ownership in them as well. But some people would say they keep it all in there, and that's fine. You can keep all your shares in there. Just know that your stop loss is always going to be 10% below your purchase price. And that's the main thing. If you walk away with anything today, walk away with that. Okay? All right, everybody. I'm about to get off of this YouTube live, and I'll be back next week with some more gems for everybody. All right, peace.